The chart shows signs of reversal. It's the early London session and we play by the book. Breakout structure? Check. Passive sellers? Check. Aggression? It's there. Precise entry? Done. But 15 minutes later, we find out we were wrong. The stop loss is hit. We missed something. A footprint was on the chart and we overlooked it. In this episode, we catch the price as it tries to fool us into selling NASDAQ, while the whole time it was planning to make a new high. Let's watch and learn together. Hello and good day. We are looking at NASDAQ 5 minutes time frame. First and foremost, we mark the highs, the lows, and find significant levels to find reversal or continuation. The London opened here at 10 a.m. local time or 3 a.m. New York time. We have a sweep below this low. We have a chain of bullish candles. It did close below half of it. And after that, the price took out the liquidity. The price should respect this topping tail candle and the mean threshold in order for us to go short. The price has reached to the topping tail candle. It has another tail. If half of this topping tail candle range or half of the recent tail of this red candle is respected, we can expect the downtrend to continue. Therefore, we should monitor the next few candles. If it closes above it, then the bearish scenario will be invalidated for now. But if it closed below it, we can use the lower portion to go short. It closed above it. Please note, during London session, we already have one sweep. We have a high. And over here, we have a full up close candle. We can submit a buy order and target the current highs based on the structure. But to have confirmation, it's better to wait for this candle to close above half, which is around $493. Therefore, if it closes above half, I can use this range to enter a long order, move my stop below at $445. Rule number one was waiting for a liquid sweep during London session, which happened here. For a continuation, the price should respect this topping tail or trap buyers, followed by the mean threshold of these three bullish candles. Therefore, we are waiting to see if it's going to close above it or it will respect and return back below this range. The price closed all the way up. I left one micro contract at the mean threshold to get an entry. The second order, I moved it slightly lower to the mean threshold of these trap sellers with the stop below this tail at $444. This down close candle gave me entry. Now the liquidity above 535 is getting thinner and thinner every time we have a bullish candle. Let me explain this one more time. London began at 10 a.m. That's here. First rule is wait for liquid sweep. It happened. Since we had three bullish candles and a sell-off, we want continuation. We wanted to participate in a sell order. The rules says we have one trap buyers in this green candle. We marked it. Footprint number one is for the price to respect half of this bull trap. It did not. Rule number two is for the price to respect half of these bullish candles. It did not. I left one pending order at the mean threshold. That's $494 and two micro contracts at the mean threshold of the previous bull trap, which is currently a bear trap. You see that complete inversion. I will examine and monitor how this breakout will be placed to check if we're going to have a continuation or a reversal afterward. We are about to have that bullish breakout. As you guys can see, the price is struggling with $535. We are having a wick. This is not a good sign. I'm going to cancel that pending order and move the stop to break even slightly higher. This shows we have passive sellers in the market. On the other hand, we have one bear trap in here. Half of that bear trap comes at $509. This area after the breakout and even before the breakout should remain open. But look, we have a full body close below this level. These are all footprints that after the breakout, we might have a consolidation or a bearish leg. For a serious breakout, the price should go above it like a hot knife through butter. That's the rule. There is a full closure above 535. Now, the next candle is very important because it should not touch the high of the first breakout candle. This portion should remain empty. The reason I am aggressive with following this trade is because of what I saw before the breakout. It didn't go up easily. It went up with struggling here with this choppiness. If the mean threshold holds, still there is chance for the price to go higher. If it doesn't, then I will be out of this trade with $88.50. We were close at with $9 this price, around $540. This is a full body close candle. Now we have a new high. Let's look at the set of bullish candles and let's monitor if the price tends to respect half of it. If it does, we can enter a short position and target these lows at 487, followed by the new low that we have from London session at $435. We are having a wick right at the mean threshold, and based on the price action before the breakout, we already know that the continuation is unlikely. On this candle, the price closed above half of these sets of bullish candles with this one. If I measure the entire gap, still it closed above it. Now I am not interested to go short. The price can potentially take this low, but that would be a very shady setup. We can try leave one pending order at the mean threshold, move the stop above the high, 495. That's the target. Stop is at 562. This is a low probability trade since from last trade we got $90. We can risk 45 in here, and based on the price action before the breakout, we already know uptrend is not serious and the price can potentially respect that high. And we have a wick. We can measure that wick to see if the price respecting that. So far so good. The wick is safe. Today we learned two things. One, we worked on our continuation trading skills, and the second one is to define if you are going to have a good bullish breakout or a fake bullish breakout, a weak breakout or a strong breakout. After the breakout, usually the price leaves a fair value gap, which was here. On this candle, it completely closed, and this is not just any candle, it is an outside candle. The high almost took the high of the previous one, and it closed below the previous candles. 1, 2, 3, 4, 5. So this candle single-handed engulfed 5 candles beforehand. That's aggression in the market. The wick is passiveness. We have another wick, passiveness, and we have witnessed aggression in the market even before the breakout. Now, in this scenario, I can move the stop to break even because the price already traded inside this fair value gap. It already filled these orders, and if aggression is enough, it should go to the target. I'm not saying with speed, but at least it shall not return back to the same area, because the handshake area is currently done. it's over. The price has been lingering in this area for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, almost 15 minutes. Now the stop goes to break even. There is one bullish candle in here. Buyers came in. Let's mark it. This is a bull trap. I don't want to see a close above it. This is good. We are building that bearish structure. It is weak, but still there is something in here. Now I am moving my stop slightly lower to secure $16. The next candle completely closed below this bull trap candle. Now I can secure more of my profit. I am very aggressive with my stop level. It's only because this structure, if you look at this structure, it more look like consolidation rather than a trend. So we don't have a clear trend in here. That's why I would like to trail it stop. Well, the profit is taken. The second order was also a success. Now looking at this bull trap, if I see a close above it, complete close, then the entire bearish structure fails, and I'm not interested to go short on NASDAQ. We have a hammer candlestick in here. That's passive. And looking at these bullish candles, these chain of bullish candles with the mean threshold at 493, we notice the price has been respecting that area, and this is where that tail comes from. Now, for that purpose, let's see if we get an entry at the mean threshold. We're leaving the stop lower. It's the same technique that we are using over and over again. The trade is active. As for the stop, I will be aggressive. I'm not going to leave it all the way at the lows because this tail and this small tail already tap into the liquidity. As for the stop, I'm going to keep it low risk and not risking more than $40. As for the profit, let's target half of this wick because it can't stand. This structure tells me we are consolidating in an almost uptrend. So yes, we are in an uptrend. The price can continue, but with not speed. There is no speed or volatility in the market, and it's obvious in this choppiness move. But still, the price is respecting our bull and bear trap levels. These sellers are trapped, and looking at the body and the wicks and the tails, it tells us, yes, we are having a bear trap in here. Another level to watch is 535, that's half. If I had 2 micro, I would have exited one at half and not risking it. But if I see a close above half, I will be determined that this uptick in momentum can continue. Even this candle is enough because it's a full body bullish candle. That's a good sign. No wicks whatsoever on this candle. If we were in a strong uptrend, the price should have left this fair value gap empty, but it tailed into it twice. I don't like that. All of these price action and candlestick patterns to bull and bear trap and fair value gaps is telling us we are consolidating and we are in a handshake area. Handshake area is where bulls and bears and institutions are kind of agreeing to a fair price, and the fair price currently representing itself in this range or upper range. Something will happen after this. When the handshake fails, the market enters into discovery mode. Either it discovers higher prices or would discover lower prices. The target is done. We will keep doing this until all of us master candlesticks, price action, bull and bear traps. Until next episode, stay safe, stay observant, and always protect your capital with stop loss.